Welcome to the Opening Bell Report.
Today, we are strapping in for a deep dive into Sigma Lithium. The ticker is SGML.
Yep.
And the story here is it's the staggering recovery.
It's really more than a recovery. It's a complete market re-rating. We're looking at a stack of sources, including a pretty comprehensive analysis report from January 14, 2026.
And that report frames this whole thing as the story of the lithium giant waking up.
It does, and you can see why.
Oh, absolutely. When you look at the raw numbers, the title makes perfect sense. I mean, for most of 2025, SGML was, frankly, just languishing.
It was dead in the water.
Stuck in this painful trading range, hovering between $4 and $6 USD.
And now, fast forward to today, and we're looking at a stock price sitting around $15.55.
I mean, that works out to a 265% jump from those 2025 lows.
Right. And a move like that requires us to look past just the surface level excitement.
Of course.
So our mission for this deep dive is to really analyze if the foundation beneath that staggering 265% run is actually solid.
Okay.
We need to figure out exactly which operational, financial, and technical factors are confirming this sleeping giant narrative in real time.
Or if investors are just getting ahead of themselves based on, future promises.
Exactly.
Okay, so let's unpack this. I mean, to go from $6 to 16 is a massive fundamental reevaluation by the market. What specific drivers lit the fuse here?
The sources all point to three primary sort of interlocking drivers. And the first one is purely about proving capability under duress.
You mean operational execution?
Operational execution. You have to remember the context. When they were ramping up production, global lithium spot prices were just crushed,
Right.
heavily suppressed. And for most junior miners, that position is what we call the Death Valley phase.
That is a powerful term. For our listeners who aren't in mining project development, what does Death Valley actually look like on the ground?
It's the most dangerous period. You have these massive, fixed cost-paying staff running expensive equipment, processing ore,
All that cash going out the door?
all of it. But your revenues are low because you haven't hit scale yet, and the price you're getting for your product is falling.
A recipe for disaster.
It is. Many junior miners fail right there. They run out of cash, or they're forced to retreat and slow everything down.
But Sigma Lithium didn't fail. They kept building.
They executed the plan with discipline. They navigated that valley by proving they could operate the plant efficiently and hit their volume targets before the market recovered.
So they proved they were a viable, low-cost producer, regardless of the price swings.
That's it. That demonstration of competence that really secured the base of the recovery.
Okay, so that successful execution is kind of a prerequisite. But the second driver, this is what elevates them. It's their unique product, the green premium.
Exactly. This is their key differentiator. And it's becoming so critical. They produce what they call quintuple zero lithium.
And this isn't just marketing fluff.
Not at all. It's 5 distinct mandates. Zero carbon, zero tailings dams, zero hazardous chemicals.
Zero water consumption from the local community, and zero toxic byproducts. I saw that list. It's comprehensive.
It is. And that level of commitment must be expensive, but the market is suddenly rewarding it.
So why now? Why is the premium kicking in now?
Because the goalposts have shifted. As we're moving into 2026, supply chain mandates, particularly in the EU, are really starting to bite.
Right. The automakers are under pressure.
Serious regulatory pressure to prove ethical and sustainable sourcing. Generic duty lithium supply just won't cut it for those big contracts anymore.
And SGML positioned themselves perfectly for that shift.
Perfectly. Their green product commands a measurable premium because it de-risks the entire supply chain for major auto OEMs.
So, okay, we have proven execution and a high-value differentiated product. But the biggest change, the one that really justifies the giant part of the nickname,
Is the third driver, expansion phase 2.
this is the big one.
This is where the valuation truly shifts. They aren't just tweaking production. They've committed to a massive construction upgrade to double their capacity.
Doubling it to 520,000 tons a year.
Exactly.
Wait a minute, though. Doubling capacity is a phenomenal change, but it's still a plan, right? It's a future promise. Is the market really justifying a 265% jump based purely on an expectation?
That's fair skepticism, but the sources argue it isn't just about the future volume, it's about the classification.
What do you mean by classification?
Doubling capacity transforms SGML from a volatile junior miner, which always trades at a low-risk multiple, into a mid-tier major producer.
And mid-tier majors trade at dramatically higher valuation multiples.
Dramatically higher.
Sure.
Because their production is seen as secure, predictable, and critical to the global supply chain. That transition is what accounts for most of the price recovery.
So the market is pricing in that new mid-tier reality, not just the current output. Doubling the company size just fundamentally changes the risk calculation for big institutional investors.
Absolutely. That's the real insight here. Now, that kind of rapid growth and massive expansion usually leaves a messy trail on the balance sheet.
Good point. Before we get too excited, let's look at the financial snapshot. What did they have to sacrifice to scale up like that?
Right.
We know they're moving volume. The analysis reports confirm that. Q3 2025 performance showed, something like 69% year-over-year revenue growth?
Yeah, and that's a pure volume story, which is really impressive when you remember that lithium prices were actually decreasing during that time.
But volume doesn't equal profit yet. You hit the key question. Are they actually profitable?
And the sources confirm, no, they are still posting net losses. In recent quarters, the EPS was negative 10 cents.
But wait, if revenue is up almost 70% and they're still posting losses, that would normally be a huge red flag.
It would.
What is swallowing all that revenue?
It's the cost of growth. The reason for the loss is clear. It's heavy expansion capital expenditure, or CapEx.
So money you spend today to build the future, the second plant, the new equipment.
Exactly. It's a drag on current profitability, but it's what ensures that future volume. The negative EPS is basically the receipt for doubling the size of the company.
So investors are looking at it more like a tech startup in hypergrowth mode. They're betting on the future volumes, not today's cash flow.
Precisely. And this leads directly to what analysts are calling the inflection point.
The moment it all turns around.
Yes. The projections show that critical shift, the move to positive EBITDA, happening in mid to late 2026.
And can you just clarify that quickly? Why focus on EBITDA instead of net income?
Sure. EBITDA is earnings before interest, taxes, depreciation, and amortization. With a huge expansion like this, you have massive depreciation costs from new equipment and high interest payments.
Okay.
EBITDA strips those out. It gives you a cleaner picture of the core operational performance, how well the mining and processing is actually working.
Got it. And that all hinges on phase 2 coming online smoothly. Let's talk about their financing, because that was, it's really sophisticated. Companies in this phase often have to do these painful equity raises, right?
They do. It dilutes existing shareholders, and the fear of it can just crush a stock price.
So what did SGML do differently?
They were incredibly proactive. First, they cleaned up their balance sheet, slashing short-term debt by about 48% in late 2025. That was preparation.
Doesn't stayed.
But the critical piece of news, the real game changer, came in January 2026, a working capital agreement.
And this involved selling 70,500 tons of lithium fines. Why was that move seen as such a massive bullish signal?
Because it was, crucially, non-dilutive financing. They needed cash to get them to the phase 2 finish line. But instead of issuing new stock, they sold a byproduct, the lithium fines, these smaller particles, to a partner for upfront cash.
So they essentially monetized a waste product to finance their entire expansion. That's incredibly clever.
Sure. It is. It's brilliant financial engineering. By getting that cash injection without hitting the public markets, they completely removed the threat of dilution that had been weighing on the stock.
And that move immediately changed market sentiment. So let's look at how analysts and the chart itself are reacting.
The reaction has been one of pure urgency. Analysts are playing catch-up. The consensus rating has officially shifted from hold to moderate buy.
And the old price targets were obviously just blown away.
Completely smashed.
Yeah.
The old targets were in the $11 to $13 range. Now analysts are racing to upgrade. We're seeing new street highs between $19 and $22.
What's the core realization driving that sudden urgency?
It's the simple reality of the supply and demand mismatch coming in 2026.
Right.
Analysts are finally waking up to the fact that global lithium demand is forecast to grow by 30 to 40% next year, and that's going to significantly outstrip global supply.
And SGML is one of the very few producers in the world set to double its capacity right into the teeth of that shortage.
The demand picture completely validates their decision to build phase 2.
Okay, let's turn to the chart. The technicals here tell a fascinating story of fear turning into euphoria.
It's a classic chart reversal. You had that long, slow bleed down from the 2023 highs, hitting rock bottom at that $4.25 base in 2025.
A very painful period for anyone holding.
Very. But that long decline, followed by the aggressive, sharp reversal, created what technicians call a classic V bottom or a cup and handle pattern.
So what was the official line in the sand, the point where technicians said, okay, the trend has officially changed?
That was the breakout move above the $12 neckline.
Right.
Crossing that point meant the long-term downtrend was over and the new uptrend was firmly established. The volume behind that move just confirmed the conviction.
So where are we sitting today on that technical journey? We're testing a pretty critical high point.
We are right at the line. Stock is currently testing its 52-week high, which is at $16.57.
And the sources point to a very specific technical trigger.
They do. A sustained daily close above 1660. That is the exact price point needed to ignite the next major move, with the next target being that $20 area.
And why does that specific number, $16.60, matter so much? Psychologically and technically?
Because that price represents the highest point reached over the last year. Breaking it means all the shareholders who bought at a high price before are finally profitable.
So the selling pressure disappears.
It evaporates, sellers disappear, and momentum buyers, the ones who love buying stocks that are going up, they flood in. And that pushes the price to the next level.
Okay, with moves this big, we have to talk about volatility and risk. What do the stats tell us?
The stats scream high volatility. SGML has a beta of 1.85.
So for listeners, that means the stock moves almost 2 times as fast as the overall market.
Pretty much. If the S&P 500 is up 1%, SGML could easily be up almost 2%. But you have to remember that leverage works both ways. The downside moves are just as aggressive.
And what about the fuel for potential sharp?
Don't forget to like, share, and subscribe for more.